We're speaking with Thomas Hayes, managing member of Great Hill Capital, about all things to do with the economy and the stock markets. Thomas, welcome to the show. It's your first time speaking to Kitco. Thank you for being here.
Thanks for having me, David.
Thomas, we're going to start with an overview of the stock markets. The S&P 500 just continues to rally. There's no end in sight. At least that's what it seems on the surface. Let's dig a little deeper. How do you feel about valuations? Do you think prices really reflect where the valuations should be?
Well, I would say this, David. After an 85% plus rally off the March lows in 2000, it's certainly getting harder and harder to find value. So we can talk a little bit about some of the sectors where there's still some value to be had. But I will say, when you look at earnings estimates for 2021 and 2022, on the S&P 500, they're about $176 a share for this year, $202 for next year, consensus earnings. And I think what we're going to find is that those are extremely low. What we've been seeing for the last 3 months is effectively every single week, the consensus estimates for earnings continue to go up. And I think what's currently at 176 for this year, we could see it hit 185, 195, possibly even 200 as that back half momentum kicks in and all the stimulus in the system. So on today's consensus earnings, the market is very expensive. However, if estimates continue to go up, both on earnings and on GDP, which are at 6%, we think you could hit 7 to 9%, then maybe the multiples aren't too extreme. However, we still want to be careful that we're not overpaying for things in the short term and that we're looking for places where there are still pockets of value.
Got a question from a friend of mine who is an investor and trader, and I'm just going to read his question verbatim because he worded it better than I could. He says, "Hey, David, how are you doing?
Great.
I'm wondering if you have any insight into what the heck the U.S. financial markets will do next. I am honestly scared of current valuations." Do you echo this sort of fear that some people have right now? Do you share the sentiment?
Well, I think, yeah, one of my knitting is sector rotation. So I think the key is to pay less attention to the general indices and pay more attention to the sector rotation and the values under the surface. That's our knitting. So last year, we were pounding the table on energy, on banks, and on defense and aerospace stocks because they were really low. I was on a segment last year when Wells Fargo was down 55%. And I said to the host, I said, "Do you think that Wells Fargo is going to do 55% less loans next year than they did last year?" And she said, "No, that's absolutely crazy." And sure enough, Wells Fargo is now up almost 100% off of its lows. So that was last year's story. I think certainly in a new business cycle, which we're about a year in, cyclicals tend to outperform. So while most banks and energy stocks are now up, 75, 100, 125%, I still think they have room to run over the next 1 to 3 years. They may take a short-term break after such a huge run. But what we've been focused on for the last 6 weeks, starting at the end of February and early March, we put out a couple of notes and we've spoken publicly that we wanted to shift into more defensive sectors. And this speaks to your friend's point, where there's still a tremendous amount of value. And what we focused on were utilities, consumer staples, and big pharma. And the catalyst for this, David, was really once we saw the stabilization of the 10-year yield. So if you remember in January and February, you had this huge disorderly blowout of yields where you saw the 10-year yield go from 100 basis points to 175 basis points in about 5 to 6 weeks, which was just tremendous. And all of the yield-sensitive defensive stocks, like utilities, like staples, like big pharma, got slaughtered in January. Mm-hmm. So by the end of February, we wanted to pick up what was on sale. And as the old saying goes, Wall Street is the only place in the world you can go when they hold a clearance sale. No one shows up. So we were the only one at that sale, maybe a few others. And with the yield stabilization, as you've seen in the subsequent 5 weeks, it's now trading in a range, the 10-year yield between 175 basis points and 150, 155 basis points. And that's now really good. We're seeing a huge bid into yield plays like utilities, staples, and big pharma. And we think that's going to persist in coming months. And the second added benefit, not only do most of the stocks in those groups yield 2 times the 10-year treasury, but if we do come across some chop in the general indices, these 3 defensive sectors are where institutional money goes to hide. So you'll get the double benefit. Number 1, you get paid to wait. Number 2, they're still undervalued. And number 3, if the general indices get choppy, it'll be a safe haven place to hide.
Okay, I'm going to bring up 2 things and then tie them together. First, you talked about yield stabilization. So, as you know, the 10-year yield, like you mentioned, has been running up a lot in the last couple of months. Why do you think it would stabilize now? It's historically speaking, it's still very low.
Yeah, I think what we're seeing right now, we've seen a little compression in yields in the last few days, is a counter trend move. And it's less important which direction it goes, and it's more important how quickly it gets there. So you have seen, one of the things that I look at, David, is the weekly commitments of traders report by the CFTC. And what I look for is, what are the commercials doing? So the commercials have been buying treasuries a bit in the last few weeks, but not to the extent where I would say that we'd expect a material rally. I do think we're going to get a counter trend bounce, which would mean a rise in bonds and a compression of yields in the coming days and weeks, which we started to see this week. But I do think by the end of the year, you are going to see a 10-year yield that approaches, if not exceeds, 2%. And the difference will be, it won't be so abrupt as we saw in January and February, where you had a 75 basis point move in 5 weeks. It will be more gradual after you get this counter trend move, where you have a steady move of 25, 30 basis points over 8, 9 months. And I think if it gets beyond that, you will see some jawboning by the Fed, like you saw in 2011 under similar scenario, where they'll start to talk about buying more on the long end of the curve, type of yield curve control, jawboning, which will keep it in check right away. So I think 2% is a reasonable expectation for the end of the year. I think you'll see commercials in coming weeks start to buy more treasuries, and that's how we're thinking about things toward the end of the year.
Now, correct me if I'm wrong, Tom, but don't financials like higher yields? Wouldn't that be good for their margins?
There's no question about it. But if you look at the 2-year yield to the 10-year treasury yield, that ratio is actually the highest it's been in 5 years. So it's steepened tremendously. And what people are missing is that historically, the short end of the curve has been higher. So the ratio is really the key, is extremely wide. And even now, if it went sideways, the banks can still make a tremendous net income margin because the economy is off the mat, and demand for C&I loans, commercial and industrial, is going to go up tremendously. Obviously, housing for millennials, you've got 72 million people starting housing formation at an average age of 30. So where it is currently, if it got up to 2%, that would be even better. But it's the steepest it's been in a handful of years, and that's great for the banks coming off of an inversion just a short while ago.
On the yield curve, you are right that it is currently at the steepest it's been for years. Now, why do you think that is? Because the yield curve typically signals growth in the economy. Are we at the same levels of growth now as the economy was 4 or 5 years ago?
Yeah. Well, the market is generally a discounting mechanism. So we talked about, consensus GDP growth is 6.5% for this year. We think we could see 7 to 9% plus. And the market is starting to sniff that out. And then you add to that, David, the amount of stimulus that's in the system is just staggering. GDP contracted 3.5% last year, $750 billion. I know we don't talk in billions anymore. We only talk in trillions, but that was the nature of the pandemic contraction, $750 billion. What did we do to offset that? Well, let's talk trillions now. $5.3 trillion of fiscal spending. You've got another potentially $2 trillion on the way with the green/infrastructure deal. Now you're at 7.3. You had Fed balance sheet expansion and liquidity of another $4 trillion. So you're talking nearly 50% of a $22 trillion economy, 50% of GDP to cure a 3.5% contraction. So there's no question what the long bond is starting to sniff out is that it's going to be really, really hard to put all this money in the system and not see some longer term inflation. I know the Fed's talking transient, but I think it's going to be a bit more than transient based on our demographics and also the millennial demand and housing formation. I think we're going to see some real inflation, not out of control, but certainly much more than we've seen in the last 2 decades, and it will sustain.
Yeah, that's an excellent point you brought up. I remember having this conversation with my friends last year, is why they needed so much stimulus. They only needed so much to bring the economy back to its current or pre-COVID levels of output, but they went way overboard. What was the rationale there? Do you have any insight?
Yeah, it's interesting because pre-COVID, everyone was talking about monetary policy had reached its limits. They were pushing on a string, and legislative authorities around the world need to get on with it and get the fiscal stimulus and fiscal spending going. Well, this certainly was the catalyst. They did it in spades. And if you look over the last couple of decades, we've really underinvested dramatically in infrastructure. And this looks like effectively a catch-up play where they're using this as an opportunity to authorize massive amounts of spending that should have been done over the last 2 decades. That will hopefully be an investment in the future if enough of it goes to the proper things like actual buildings, like actual bridges, like actual roads. You could make an argument for actual broadband and that type of some of the softer parts of the bill. But it's overdue, and I think they just said, well, if the checkbook's open right now, let's think about it. And a lot of people worry about this, David, but I will reference back to post-World War II in the late 40s. We got up to 120% of GDP, and within a handful of years, by the early 50s, we were back to 63% of GDP, and that was able to be funded by growth in the economy. So we're hopeful that we can see this level of growth sustained and bring that debt to GDP ratio down as we did in the late 40s to early 50s. But it remains to be seen.
Yeah, the operative word there is hopeful. I don't see how they could do it.
Yeah, it's really going to be a question of growth. And do you see the velocity of money pick up? So we've had a tremendous amount of money creation, but we really haven't had the velocity, the transactions. And I think as we see the reopening and people getting back out there and the economy reopening, that velocity will pick up. We will see growth. We will see inflation. And whether it can bring us back down to 80 debt to GDP of 80% or 60% in the next 5 or 7 years, it remains to be seen. But like all governments, over time, they inflate their way out of massive debts is generally the strategy to move forward. But you also have with this administration taking aggressive action on the revenue collection front as well. That will offset a certain amount of the increased debt to fight what now has been an invisible enemy, what was in World War II a visible enemy that the country had to do tremendous borrowing to overcome.
Okay. Now, you brought up inflation. Let's talk about inflation for just a minute here. Do you see inflation rising to above the Fed's average of 2% target?
Yeah, there's no question about it. And the question is going to be, how long do they let it run above 2%? He's talked about symmetric inflation. Well, he'd have to let it run over 2% for 5 or 10 years to make up for the last 10 years of running below target. And I don't see him doing that. I think they will blink when they see a 3 handle for at least a quarter or two, and they'll start to raise the short rates pretty quickly. But I think that it's reasonable to expect we could see a period of years closer to 3% inflation sustainable, but not really. They won't let it get away from that. They'll raise rates ahead to preempt it. But certainly, I don't think we're going to see a sub-2 environment like we've enjoyed for the last 10, 20 years.
So let me ask you this. When inflation reaches the 3% that you were talking about and the Fed needs to step in and raise rates, wouldn't that cause a huge monetary contraction? What's the stock market going to do? Is that going to send us back into another recession, you think, possibly?
Yeah, it really depends on the momentum of the economy at that point. I do think that velocity is going to pick up and we're going to see growth greater than expectations. So, what you'll see in the early part of the cycle, the Fed started raising aggressively in 2003 of that cycle, and that cycle lasted another 4+ years despite the constant raises of interest rates. I think that in this case, with the millennials now, 72 million people, average age of 30, if you look back to the early 80s, what drove that boom from 1982 to 2000 was really the baby boomers, which are less than the millennials in terms of size, about 70 million. They were starting housing formation in 1982. And that really drives growth, that level of spending that we're seeing, that'll pick up velocity. And we're just starting it now for the first time in all of those years. My generation, Generation X, was much lower in terms of population, in the low 60 million. So that's why we've kind of had this sideways economy for 20 years. And now with the millennials picking up, I think we could see a similar 10 years moving forward with higher inflation, but also higher growth. And we could have 10 years of really strong growth as we see this housing formation, demand for housing. When people buy houses and they start families, they buy furniture, they buy cars, they buy clothes, they buy all these different things that drive the U.S. economy.
Let's talk about some of the stocks that you like now in relation to the sectors that you like. So if you could drill down to the more micro side, that'd be great.
Yeah, no question. So I think what I'll start with, because utilities have had a huge run in the last 6 weeks, we think that they have more to go in the next few months. We were big buyers of American Electric Power and Dominion. On the staples side, think soup and cereal. We were buyers of Kellogg and Campbell Soup, even General Mills is an opportunity there. But these have moved up pretty big in the last 6 weeks when we first got out about them. But what's available today that's just started to move is some of the names in big pharma. One of the names we were talking about this week on the sell-off on the bad news was Johnson & Johnson. Many people got nervous because there's a delay in their vaccine. One of the things about J&J is, first off, it was a 1 in a million situation, about 7 people out of 6.8 million vaccines. There will be contraindications. They'll probably put a label on it. If you have low platelet count, or if you have XYZ, then get a medical exemption. For everyone else, they'll find that it's perfectly safe. That will be back on the market. So that was certainly a buy. And this interesting thing about it, it's trading at 15 times next year's earnings. Its historical average multiple for the last 10 years, David, is about 18 times. So you're getting it at a huge discount. The dividend yield is 2.5%, which is greater than the 10-year yield. But what's more interesting about that yield, David, is the fact that J&J has raised that dividend every single year for almost 60 years. So it's not just the yield you get today. They're going to raise it every single year that you hold it. That's number one. They've got 50% of their business only is pharmaceuticals. They've got great momentum with their arthritis drug, Remicade, some of their psoriasis drugs like Stelara. But medical devices are a third. And then they've got their consumer products. Think baby oil and Band-Aids. That's 20% of the business. So it is a diversified business. It is pretty cheap here. We like that one. We also like Pfizer. Pfizer is extremely interesting because they'll be the beneficiaries of the short-term worries over the J&J vaccine. They are trading at 12 times next year's earnings compared to their historical average of 14 times. Versus the S&P 500 is trading at 22 times. So you basically get this quality company for half of the S&P multiple, 4.2% dividend yield. That's 2.5 times the 10-year Treasury. They were the first mover in the vaccine space. They also have Eliquis, which is a blood thinner. It's up 17% year on year, their sales. And finally, we like Novartis, which is another big pharma company. They're trading at 12.5 times next year's earnings versus their historical average of 22 times. They yield 3.6 times, which is about 2 times the 10-year yield. And they're a play on the second half recovery and normalization of healthcare. So right now, everyone's afraid of COVID. But by the second half, when they're all vaccinated and they're going back to their doctors, they're going to say, wait a second, I'm overweight. I got to worry about diabetes. I've got to worry about high blood pressure and cholesterol. They're going to renew all their scripts. They're going to come out with a handful of scripts to deal with that. We've all packed on a few pounds during COVID. And I think many of these healthcare stocks are going to be tremendous. They have their heart failure drug, Entresto. They have Cosentyx, which is for psoriatic arthritis, and they'll have gains in their oncology portfolio as well. So those are the three names in big pharma that we've really been focused on in the last couple of weeks.
Okay, so I understand. Your thesis is more to do with the other products they're offering besides the vaccines, because it's pretty much, from my perspective, they've announced, well, we know how many doses of vaccines we need for the entire country, and these companies have pretty much announced how much they're able to produce over the next year or so. So I would assume that the markets have already baked in the valuations on just the vaccine component.
Correct. Yeah. Well, in the case of Novartis, they have no vaccine exposure. In the case of Pfizer, it's certainly a meaningful part of their business, but just part of the story.
I see.
And in the case of Pfizer as well, the CEO came out yesterday and said, oh, by the way, everyone's going to need a booster shot in 6 to 12 months. So that's not actually baked into the $2 billion that they promised by the end of the year. And that's why you're seeing the stock is up today. And I think it's just the beginning. As you get more variants, the mRNA vaccine companies like Pfizer, like Moderna are going to have an advantage because they can adapt their vaccines to any variants much more quickly than the other companies. So I think there's much more juice in the vaccine business, but also in their standard business in the second half, healthcare normalization, they're going to get a huge pop there. And we like that quite a bit.
Fantastic. Thomas, it was fantastic speaking with you. Welcome to the show, and I look forward to speaking with you again.
Thanks for having me, David.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more updates.